Hi, I'm Andrew Kirsh, co-founder of Sklar Kirsh. On this podcast, I interview industry leaders. You'll hear their real-time opinions on today's market, their background, unique career highlights, and guidance for newcomers to the industry. This is the Kirsh Connection. Welcome to another edition of the Kirsh Connection. I am finally back home for my 2-week East Coast trip to Washington, D.C., Philadelphia, and New York. Had an absolutely amazing time. The weather cooperated for the most part. And even though I've been to those cities on business trips and conferences, it was really great to see those cities through the lens of my two kids, Clementine and Maverick. So in DC, to see the monuments and the museums and just the unbelievable sights, it was spectacular. Philadelphia, I think, was better in the day when Courtney was attending college at the University of Pennsylvania. It reminded me of parts of LA. They need to clean up that city, unfortunately, from homelessness and just overall vibes. She said it was not the same as when she was in college 20 years ago. And then we wrapped up the trip with a week in New York. And I know there's a lot of political discussions on the leadership in New York City, but from my perspective of being a tourist and seeing the city, being in Central Park and seeing the sights, I got to tell you, it was a lot cleaner than LA. It seemed a lot safer than LA. And one person who I met with said they would rather walk at 4 a.m. from the Bronx to the tip of Lower Manhattan than walk in downtown LA at noon. So what does that tell you? And yes, I did get some feedback saying, hey, Kirsh, go spend some money on an outdoor mic so we can actually hear you when you do your intros remotely. So that is coming along the way. On this week's episode, I have my good friend, Jeff Jaeger, the co-founder of Standard Communities. When people talk about the affordable housing business, they talk about Standard Communities. They are one of the bellwether companies who buys existing product of affordable housing and builds ground up throughout the country. I hope you enjoy my conversation with Jeff Jaeger. Welcome to another edition of the Kirsh Connection. I'm here with my good friend, Jeff Jaeger, the co-founder and principal of Standard Communities. Jeff, how you doing today?
Doing great. Thanks for having me, Andrew.
Yeah, absolutely. You know, whenever I talk about affordable housing, talk to affordable housing clients or those that are in the industry, if I mention Jeff Jaeger, Standard Communities, are like, oh, that's the bellwether of affordable housing.
Oh, thank you.
So you guys have established an amazing name and reputation.
Yeah, thank you. I mean, it's amazing. Like when we started in this, that, you know, if you put my name next to or our name next to affordable housing, that it wasn't even an industry. So it's kind of fun over the last 20 years to watch it evolve into becoming its own, you know, kind of asset class and something that institutional investors and different people are starting to really dive into and track. So it's been a fun journey.
So let's start with just, you know, what Standard does. Obviously, we touched upon it, and then just a little snippet, and then let's get, you know, into the history of yourself and how you built it.
Yeah, totally. So, you know, affordable housing, really simple to kind of boil it down. Really, we think of capital A affordable as having two components. One, which is you either have a rent restriction on the housing, so it's restricted in some way to rents and income levels, or you have some sort of subsidy involved from the government, which they're paying part of the rent. Those two things can be independent or they can be intertwined, right? And I think over the years, most people have viewed, because of those restrictions, that it's been a limited area to deploy capital, just because of limited returns, a limited upside, you know, et cetera. I've heard throughout my career, everyone terms it a fee business. Like, oh, affordable housing, oh, it's that fee business that you're in, right? And I think that people are starting to realize, based on the way that affordable housing was constructed in the U.S., it's one of the best public-private partnerships that's out there that exists, I think, and has been a great testament to the way the federal government and local governments work together to kind of build infrastructure and housing. And with that, you know, there's real capital to be deployed and profit to be made by the private sector in the space.
But do you feel like there are more real estate companies who are getting into affordable housing in the last couple of years? You know, the first 20 plus years of my career, I probably didn't do any affordable housing deals. And now in the last several years, there isn't a week or a month that goes by where I'm not doing another affordable housing deal.
Yeah, I mean, absolutely. I feel like there's definitely been a light that's been shown on the industry and the asset class. And like I said, it's an asset class now. So, everybody wants to have a piece of it, in some part of their portfolio. I think the resiliency of the assets through the last downturn, you look at how a lot of the Sunbelt markets that everybody kind of dove into performed, and you compare that to affordable housing. And the returns have been really compelling. I mean, we've seen tremendous rent growth in the space. We've seen great exits and back end upside on the deals. And so I think that there's a lot of people that are not looking at affordable who are now looking at it. It's one of my concerns with the space is having people that don't have a lot of experience with it jumping in and coming into the space and what that does. But I think overall, it's a really good thing to see capital flows moving into the space.
All right, so we're going to dive much more into it as our conversation evolves. But let's get back to where did you grow up?
I grew up in LA.
Yeah.
I'm born and raised LA. Went to high school here. Went to Harvard Westlake High School, and then went up to the Bay Area for college. So I've lived in California pretty much my whole life, and kind of LA has really been kind of mainly the place that I call home. So.
Yeah. And then, so when you graduated college, what did you directly go into the real estate business?
So I was a philosophy major in college.
Oh, that's a good precursor for
real estate.
estate.
Absolutely. I'd say all the philosophy jobs, were taken, so I had to find something else to do. So why not affordable housing? But no, really, like I was a philosophy major in college. I knew I had wanted to get into real estate. My father was in retail consulting. And was, a really successful consultant for retailers that were going out of business. I love the deal making side, et cetera. He had dabbled with a little bit of real estate. But when he bought real estate towards the latter end of his career as a retail consultant was like in the late 80s. And, he got hit in the early 90s with a huge downturn. So a lot of my upbringing growing up was my dad going through a major bankruptcy over a lot of the real estate assets that he had bought. And so that was kind of always lived in my head. So coming out of college, I kind of wanted a second chance at real estate seemed really interesting to me. Seemed like something that I was familiar with and heard at like dinner tables in terms of how they were trying to work through the assets and resolve everything. But at the same time, I knew nothing about apartments and specifically nothing about affordable housing. And so I really kind of came with an open mind with real estate, trying to figure out what I wanted to do. And originally I got a job with a pension fund advisory firm in the Bay Area, which was doing acquisitions work and doing it across the board in all over the country for all different asset classes. And that was my first introduction to like, what is real estate as an asset class? What does it mean to buy things? Working at an institutional shop. I tell everybody who comes in, starting in the space, I had someone who came in my office yesterday looking for advice and, getting started in real estate. I'm like, I think it's so helpful to work at an institutional shop when you first get out of school for a couple of years to get that experience. And I had that benefit and it really stood me in good stead.
Yeah. And so what time period are we talking about? Late 90s, early 2000s or?
We were talking about 2000, .com had just happened, right? Like coming out of college, I graduated in 2001, 2002. And so we're talking about I started at Lend-Lease in the Bay Area, I think 2001. Mm-hmm. So, 2001 to 2003.
It's funny. You mentioned Lend-Lease. It's all public, but dealing with them with respect to graffiti towers.
Yeah.
And that is a major.
So I remember Lend-Lease was, it's a really, they have a really interesting story. I mean, now that Lend-Lease, it's an Australian-based company, right? They had, when I started working for them, they had done this huge roll-up in which they had rolled up all these, at the time, they had an affordable housing player. They had MMA Financial was part of Lend-Lease. They had bought Equitable Yarmouth, which is the pension fund, insurance business. They had, several funds, which is the prime funds, which are now at Morgan Stanley. They had Bovis Lend-Lease, which was the construction division. and they had a developer. I mean, it was just like there was like everything under the sun was there, and it was a really good place to see. I mean, I actually had someone working doing affordable housing that was in my office there that I had no idea what they did, but it was like all there in that office. And it's since been sort of disbanded. And I think like with Graffiti Tower, you know, it's just the Australian based, you know, kind of, I think it's just the construction company.
Yes.
At this point that was doing the construction
Correct.
stuff. I'm not sure they probably have an appetite for doing a lot more in LA after that.
Yeah, that is definitely an eyesore on so many levels. So how did you get into affordable housing? So you were at Lend-Lease, and then what made you pivot?
Yeah, so I was at Lend-Lease. I really kind of started specializing in apartments first. So it really, I didn't dive into affordable to get, you know, out of the gate. Apartments caught my eye. I was working on office. I was working on hotel. I remember I worked on the Montage deal in Beverly Hills, which is now the Mayborn.
Yep.
When that was getting entitled, that was a Lend-Lease deal way back in the day with Athens Group. And so, you know, I put together a pro forma on that and those sorts of deals, right? And I think pretty quickly, I really liked apartments from the diversification of the rent roll standpoint. It seemed to me that one, you know, you were never taking an over amount of exposure on any particular tenant. It was, you had, there was always 300 tenants, 200 tenants. They had all different jobs across all different industries. It seemed like if I was going to make a mistake, right, it was like, you know, kind of, I felt like I didn't love the leverage as a young person getting into real estate. I guess I knew if you were really successful and had a huge portfolio of office and you had millions of tenants, you could have great leverage in your negotiations with different tenants and feel comfortable owning a large office portfolio that was unleveraged across the board, maybe until 3 years ago or 4 years ago. Until COVID, right? But, looking as a young guy getting into real estate, right, it was like, okay, I'm going to buy one asset. I'm going to have 8 tenants. One of them comes and negotiates with me. And, I felt like I was going to have no leverage and there's no way I was going to be able to make a successful deal. I felt like with an apartment building, I could have leverage with tenants. One person comes in, I could demand higher rent. That dynamic made sense to me. And then, kind of add on top of it, the fact that every other real estate class, it never made sense to me why the CapEx and, kind of TIs in commercial, right, were all below the line.
Yeah.
I was like, these are just like ongoing expenses. You own an office building, you're constantly paying for TIs on every office. On apartments, all of our TIs and leasing commissions are all above the line.
Right.
So it just like there's a few of those things that stood out to me where I was like, this is way more interesting to me as something that I would want to put my own money into versus managing institutional capital for somebody else. And so that was kind of going on in my head. And I met a couple of guys who were brokers in the Bay Area and really successful and had been building a portfolio themselves in the Bay Area. And I worked on a transaction and, I remember looking at the closing statement, looking at how much they were making on the sales side. We were buying a deal from JPI way back when. It was probably like an $80 million deal in the Inland Empire. And, you have this $80 million deal there. My boss, I know generally speaking what his compensation was, and we're all salaried employees. And I know what, the seller is making at JPI, right? And I'm looking at the commission on the brokerage statement. I'm like, this guy's making, like 4 times whatever he was making in like a single deal, right? And so then I started talking to him, like, okay, like how many deals are you doing? And at the time it was, you remember the condo craze way back when, if you had any deal that had a condo map on it,
sure.
you could. So there was like right in the height of that. And I was, talking to those guys who were doing the brokerage business, and they're like, yeah, we're selling $3-6 billion worth of deals per year. I'm starting doing the math. I'm like, what are you guys doing with all that capital? Like, where's it going? Like, well, we're buying apartments. And so we started to have the conversation of like what they're doing with the capital, if I could be of use, helping to kind of manage deploying that capital, leveraging what they had bought and their track record.
I thought you were going to say you were going to go in the brokerage business.
Yeah, it was tempting. I thought about it for a minute. It's definitely tempting. I worked in the brokerage office there for, a couple of years. So I got a good taste of working on the brokerage floor. And I think that you get a really healthy respect for, the hustle. So I worked with those guys and helped them grow that business, which today is called Jackson Square Properties in the Bay Area. And they've been incredibly successful and taken that to, kind of a really kind of whole nother level after I left as well. But those guys, they were really focused on market rate apartments. However, the guy who was kind of one of the main principals there had been doing a lot of these apartment deals and had tax-exempt bonds associated with them. Not tax credit housing, not true affordable housing. These were things, this was a program that was before 1986 where you used to be able to get tax-exempt bonds for some, kind of very small use restriction that was on the property, maybe 20%, maybe only income restriction, not even rent restrictions. Mm-hmm. And you got this advantageous debt that was at a discount to market. And he would find these deals and he would restructure that debt. And the returns, when I started looking through, I was building the materials to raise capital for them, and the returns were like outrageous. Like I've been looking at institutional deals for a while, and I'm used to saying like, okay, is that a 15% IRR or 20% IRR, right? And I'm looking at these deals and I'm like, wait, they put up like $100,000 and it's cash flowing $4 million now, and then it's like they sold it and exchanged it for $60 million, and I was just like, these returns weren't making sense to me.
Yeah.
And so, these were deals also that came out of like the RTC days, right? And I spent tons of time just like, okay, well, how does this work? It just like blew my mind. And so when I started to really understand how those tax-exempt bond deals worked, how you could restructure them, that opportunity had sort of passed. Those deals had kind of played through, but it really, for the first time, cemented for me like that public-private partnership element of like, okay, how do you use the tax code? How do you look at, kind of these special programs that are out there to enhance your return and generate above market returns, and programs that nobody knew about? And there was, you could really get a leg up by, knowing about those programs in some way.
And so that's when you started Standard Communities?
So, yeah, I studied those programs for a while. Mm-hmm. I did some of them with those guys. Mm-hmm. We bought about 15,000 units. This is like 2003 to like 2006, 2007. The writing on the wall, like 2006, 2007 starting to happen. I think it was right around 2006 that I had some friends that were at Citibank, and they called us up and they're like, hey, you're doing all sorts of tax-exempt bond work. Have you looked at doing tax credits? I'm like, what's a tax credit? So like, why don't you come to our office? We'll do a presentation. So we literally sat in their office and they walked me through what tax credits were. Mm-hmm. So I asked a bunch of questions, figure it out. And, next thing I know, I was out trying to tie up deals to do tax credit affordable housing deals, and we were buying existing assets. And I did 2 deals with those guys that were, we figured we'd start small. So went out and tied up an 800 unit asset in Chicago that seemed like it checked all the boxes and worked. And we converted it. And in doing the process, you had to spend a massive amount on renovation. And so we started a construction company, and the construction company then did the renovation, and then we converted it, and it ended up being a really successful deal for all the stakeholders involved.
And really, so just for my knowledge, when you say convert it to what?
So we converted that, we issued tax credits on it, and we restricted the entire property to affordable housing.
Mm-hmm. And what type of income levels, average?
So we made that
medium?
deal 60% of average median income. That the rents were, about where the market rents were at the time. So there wasn't a huge change between where the restricted rents were for being affordable and what the current rents were as the deal as just operate as a normal apartment deal. Mm-hmm. However, we were going to spend, $35,000, $40,000 a unit renovating the deal. So theoretically, there was a rent increase to be had at the deal, but we were going to keep the rents relatively flat. So you were sort of...
But the tax credits were that accretive.
The tax credits were that accretive, but really at the time, because again, I wasn't an expert in tax credits at the time, I knew tax-exempt debt. Mm-hmm. And so really on that deal and my early deals that we did, we figured out how we could get, there was floating rate debt that was tax exempt to be had. And Fannie and Freddie had programs for it. And so we did this tax exempt debt program that... just to give you I think the rate on some of those things at that point was at 1%, right? And so you're underwriting these deals to have them make sense at, probably close to 5-6%. So there was a 4% spread on the debt to pick up, right? That was cash flow that was accruing to the deal. And so the play was really a debt deal on those deals. And the tax credits was an essential component on the equity side, but we were really focused on that debt piece at the time and using what I had learned with those guys to restructure it and put that together. And so I did those 2 deals. We made it through construction, and then the world started falling apart in 2007. And I really wanted to start my own business. And I kind of those 2 deals didn't require any equity. So, I kept wanting to negotiate for more equity, as every junior partner should want to do at any company they're working at, right? Is coming into their,
including standard communities.
So I encourage it amongst everybody that works for us is basically, everybody should be fighting to come up and hopefully take our jobs and continue to move up, right? And I think that, I did the same thing and kind of figured out as we went through this, I was like, wow, this doesn't require any equity. Why am I negotiating for a bigger piece? I might as well start my own company. And that was the genesis of really where I had been talking a lot with one of my close friends in San Francisco, Scott Alter, and we were both living up there, and he was working for Stockbridge at the time. And I was really an operator background at this point. And Scott was working at Stockbridge on the capital side. And so we've been talking for a while about doing something together. And so I called him and I'm like, hey, let's put something together. I think there's an opportunity here. And that's what, kind of led to us moving down to LA and then launching Standard.
And so was the initial thesis to buy existing and convert it like what you did in Chicago, or was it to do ground up development? What was it?
Yeah. So the original thesis was, it was the Great Recession. It was like, we just knew there was going to be a cheaper opportunity. We wanted to do something with an affordable kind of lens to it in a bit, right? But we were open to any opportunities in kind of distressed real estate, right? And then, I think maybe 3 months or 2 months after we founded the company, Lehman blew up, right? And I remember looking at Scott and saying, we thought it was going to get bad, but I didn't realize it was going to get this bad. And so everybody recalling, things just froze.
Yeah.
Right. So affordable housing, there was no buyers of tax credits. People banks that we had been doing business with, or thought were credit buyers of tax credits, doing loans, were all of a sudden defaulting on, equity payments and tax credit deals. That market was just blowing up. The market rate space was blowing up. It just was blowing up everywhere.
Sure.
And you're trying to make deals and, putting in offers on deals and, trying to just, value was 25 million. And I remember saying hey, we're going to bid 25. And they're like, well, our loan is 38, and it's like, you weren't even talking to the right party in terms of trying to make a deal.
But would you say that this was the right time to start the company? You didn't have any legacy assets.
In retrospect, it was the best time ever to start the business.
You were buying at the bottom.
Totally. At the time, it was, and I've seen now a few different cycles as we've gone through. We've been through kind of this COVID cycle as well. And I think that, every time the cycles happen, you want it to be 5-10% cheaper before you're ready to buy, right? It's like, I remember thinking we need to be at 8 caps, when we were, kind of in the Great Recession, right? And it's like things were trading at 7 caps, and we're like, just this is not quite cheap enough. If it just goes to an 8 cap, we'll pull the trigger. And I think it takes. You have to have that fortitude of knowing what you think are good deals. And then when the recession happens, just pulling the trigger and not trying to time it to when is the exact bottom. And, and I think it's also easier to miss on the way down. You're better off picking it kind of going on the way up. Mm-hmm. And so we've kind of kept that in terms of the way we've been buying, but that's sort of stood us against stab during the Great Recession. So we started really, answer your question, the affordable housing market sort of just froze. There was nothing to be done in affordable housing. So we really pivoted to buying distressed debt. So we started calling banks and buying paper. And so our first deals that we did were buying notes in New York City, in, rent stabilized kind of is a, subsect in kind of the affordable spectrum. And so we were buying, rent stabilized loans in New York City. We bought in DC and Phoenix, anywhere we could find distress and we could find paper that was moving. There was a 1 to 2 year window where banks were fire selling stuff.
Sure. I talk about it all the time that during those days as a lawyer between '08 2012, a week wouldn't go by where a client would come to me and say, hey, we could buy this loan or this portfolio of loans. I have to close within days. Just make sure that there's no nuclear missiles in the documentation, but we're essentially just buying it because it's so cheap.
Yeah.
And we're not seeing that in this cycle.
I wish we were close during those days. I would have been calling you.
Yeah, totally. But this cycle, we're not seeing that, right? We're seeing some one-off loan sales, but it's few and far between compared to what we saw 15 years ago.
Yeah, it's interesting watching it play out that time. I remember specifically bidding. So this was like 2008, right? We started bidding on these loans. And the first loans we bid on, I remember, was the WAMU portfolio that was coming out that JP Morgan took over. And I remember putting in bids, and these were like buildings in Manhattan, Harlem, and kind of the Bronx and different areas. And we were bidding 50 cents on the dollar on these WAMU loans, 55 cents. And the bank just like kind of laughed at us and was like, we're not sellers. There's no way, whatever. Right. And it wasn't until we got a call on our first loans, like December 22nd. And they're like, hey, if you can close by year end, they're yours.
Wow.
Right. At your price.
And so how'd you come up with the cash?
We strung it together. So we, on our first deal, there was a receiver in place that was on the deal. We knew the receiver. We called the receiver and was like, hey, do you want to partner on this and do it together with us? You do 50%, we'll do 50%. He was like, I'm good for my 50. We said, we're good for our 50. And we put together in 8 days a partnership to buy it together. And we knew the receiver who knew the asset well, who was managing it. And so Scott and I pretty much funded that ourselves. And I think I got a loan, from family for, a small amount. I remember my dad charging me, 15% on that deal specifically.
Thanks, Dad.
Yeah, exactly. He now, regrets that he didn't take that as equity instead of debt. Would have been a better deal for him. But yeah, so we hamstrung it. We put it together in the first few deals like that. And the notes were really fast, right? It was like you got that call, and we were competing with institutions and funds, and so you had to move in a 7-day period from start to finish to be able to buy paper. And you didn't know whether you're going to win, so you couldn't line up the capital. It was just a very hard and stressful business.
And so did you end up, foreclosing and taking ownership of those assets? And
we took, I would say 70%, 60, 70% we took control of through the foreclosure process. Most of what we bought was judicial foreclosure deals, because the banks were more willing to sell and fire sale in those markets because it took longer.
Sure.
And so we bought a lot of litigation. So we ended up in litigation in a lot of places. There was about 20% that we were able to let go at the courthouse steps. So we brought it to the process. Remember, we had a portfolio in DC that we bought, and we took that to the courthouse steps and made a deal literally on the courthouse steps to sell the assets to a company, a local-based company in DC. And then we ended up with one that we just ended up keeping. And then and then there was a couple that we had some borrowers that were special, as they call them. And, I think we had one that took us literally 6 years to get a hold of the asset. And the guy pulled, you gotta hand it out, hats off to the guy. He pulled every trick in the book, in terms of the legal process.
Hey, you know what? When we represent note buyers and we talk about the tales of what a borrower could do, and I'm now going to use that story because I haven't heard of 6 years. But as Standard, evolved, was the focus, did it pivot to a ground up development play?
So there was I would say a lightning bolt type, lightning bolt sort of moment, right? So we've been buying loans, and I don't know if you remember this, it just shut off, right? It was one day the spigot was just no more loan sales.
I would say in 12, maybe 2012. Yeah,
I was gonna say 11, right?
Yeah.
It was we started calling all the same banks that we're calling. We're like, what do you got for us? New York Community Bank was on there, a bunch of different banks, right? And we're like, what do you got? And they're like, we've been instructed basically not to sell any paper and not to fire sale. Fire sale's over. And we're like, why? And they're like, well, we got TARP. And we have this money that came into the system. And so we started looking at the money that was flowing into the banking system and just the vast amount of public money that was flowing in. And it was Scott and I both looked at each other and were like, how do we get, take advantage of this money, and how do we get ourselves positioned to, really a line of business that can take advantage of that capital flowing into the space. And that was where this lightning bulb came off, that it was like, wow, the banks are no longer independent financial institute. I mean, they are public-private partnerships themselves, right? I mean, they had public money that was coming in. The public were shareholders inside the banks with these TARP funds, effectively. And, it just seemed like the housing sector as infrastructure was going to head in that direction as well. And so we really then pivoted at that moment and said, look, we need to put all of our, focus and direction into an affordable housing business. We need to do it at scale, and we need to position ourselves so that, the government is effectively our customer at the end of the day. And how do we develop, kind of the largest platform in the country to help the government fulfill its mission to provide safe and dignified housing for, everybody across the spectrum. And that was probably 2012. And since then, that's really what I think the standard that everybody knows today kind of became. And it's really where we, really focused on scale, right? And that's what I think has differentiated us today as well, is how we've built systems and scale to be able to handle volume in a space that is incredibly tedious and cumbersome, and has tons of paperwork, and is something that has been very hard to scale.
What would you say? I know you don't generally work and buy or build market rate, so maybe you don't know the comparables, but the return on cost in building an affordable deal versus a market deal?
Yeah, so we do build some market rate, or we have. I think that, it's a very different metric for building affordable housing. I would say that, if you equate on the affordable housing side, you need to be building, typically for around, I would say, the way we look at it is probably, if you need, I would say on the return on cost today in today's market in California, if you're doing a development deal in California, which is rare today, right, on the market rate side. But I would say like private investors that I know that are more interested than institutions today are probably looking at stuff that's still in like the sixes.
You're right.
From return on cost, low six, mid six cap range, right? I think that you are solving on the affordable housing side for trying to get a tax exemption for providing that affordable housing. And then you still need to be probably pretty similar, maybe slightly higher, 6.5, 6.75 from a return on cost standpoint, to make an affordable housing deal make sense. If that translates to like the way a market rate kind of person would think about it. But you're using a different metric because you have no taxes on the property tax side, which is a major part of the, kind of the return on cost calculation.
Look, if I'm doing a market rate deal, I know exactly the cities that my clients are transacting in, whether, it used to be the Pacific Northwest and then the Sun Belt of Phoenix and Vegas and Dallas and Nashville and parts of Florida. When I'm doing an affordable deal, it could be cities I have never heard of in the country, from West Virginia to the rural parts of Pennsylvania to in between. And I'm bewildered of how my clients are finding these locations and finding these properties more on the existing side, where it seems like the location, I don't want to say is irrelevant, but is not necessarily as critical as in a market rate. Is that fair?
I think that, that is certainly a factor of what has happened when people come into the space. I think you see the same thing, in the market rate space. I remember in 2005, 2006, when it was super frothy on the market rate space leading up to 2007, right? You had all this talk of secondary, tertiary markets in the market rate world, right? And so I think right now, affordable housing's pricey and it's gotten expensive to buy from a yield perspective in some of the primary markets. And so you have a lot of people chasing yield and going into these secondary and tertiary markets. And the histories of the program are such that deals got built in these other markets because there were programs that allowed for non-economical deals to get built. The original program that was built in the 70s under HUD, which is a lot of these subsidized housing deals that were built, were such that it was meant to incentivize if you wanted to build a tower in Fresno, there was no way that was going to pencil at all, right? And so the federal government made it so you could build a tower in Fresno, right? So now you have this tower in Fresno that's there, that's trading at, that shouldn't be there in the first place. And like, what yield does that trade at, right? And it's clearly not a replicatable asset, that anyone's going to build to compete with you on in that place. And that Fresno is probably more infill than a lot of places you're talking about. This goes on throughout the Midwest in small little towns. There's rural housing, USDA housing. So there's other programs that even were built for farm towns. So, the government has had to solve the problem of, there are places that need housing where it's not economical to build housing. And so the government has played that role of trying to build housing in those locations. And so now it exists there. And, somebody who comes in and buys that afterwards, is making an investment play. And the question is like, is that a good investment? Is a different question than, are those opportunities there? We have really focused on the same growth drivers that exist in affordable in market rate housing, which is, we are very big on job growth. Kind of the economic flywheel needs to be working, where you have, policy locally needs to be aligned with growth and kind of job growth and everything else. And then you need, population growth, as well as, kind of limits on supply construction as well. Places like Austin in the affordable side is getting killed just like the market rate world's getting killed, right? There everything was working except they built too much housing. And so, and the irony is that like everyone complains about not enough housing here, right? And then in Austin they build too much, and everyone's like, oh my God, they overbuilt the market.
Yeah, you go into Phoenix and other markets, and you just see crane after crane after crane, and peers of ours, clients of mine, who own in these markets. The rent concessions at least 2 months, if not more, and negative trade outs. They're struggling, and they're hoping that supply will tamper down in 2027. They're not seeing as many new build permits, and that supply will really come in line in 27, and rent will stabilize. And you flip that on its head to Los Angeles. And I know we've talked about this before, not on the podcast, but before the podcast. And, how can we solve the affordable housing situation in Southern California?
Yeah, it's a complicated question. A couple of things to just hit on that I think that you said is, one is, I think, look, we're buyers, like, not necessarily through standard communities, but Scott and I, are placing as we continue to diversify our capital and, do stuff, via our family office. Like we are buyers of market rate deals in some of these markets right now. Like, we like those markets like Phoenix. I think we're doing a deal there with a friend through other platforms. We're investing with friends, but providing capital. And I think that it's an interesting time right now where the institutions haven't dived into those markets in a huge way. Rent concessions are really big. We think those rents, under our kind of metric, the market rate deals are really affordable today.
Yeah, you're talking about like 80s type construction where institutions will not go into those deals anymore.
And you look at, we're looking at a deal like right now that we're doing in Phoenix, and like the rent levels there compared to our affordable rents in California are less, right? And you're buying high quality assets in Phoenix. So you sort of, we think about it as another sort of, affordable angle, although it's not restricted at all in some way, right? But, I think that, coming to California, I think the problem is way more complicated than the housing, right? And I do think that people are realizing in some of these markets, like, rents, I think in a lot of these other markets, a lot of the Sunbelt markets, right, have become much more affordable in areas like Phoenix and Austin, et cetera. Like, and I think that the story isn't about the creation of affordable housing in those areas. Now, you need to keep doing affordable housing so you don't fall behind, but they've sort of been able to build enough. They've created enough job growth in which, wage growth has kept up, where, the last several years, they've seen tremendous wage growth. Rents have been, flat to slightly declining. And so on a real adjusted basis, those rents have become truly affordable for those people that are making more money. California, that flywheel, and LA specifically, has broken, right? We're not seeing wage growth in LA County or LA City the way that we're seeing it in a lot of these other areas, right? And so people are feeling this affordable sting here, right? And we also are not developing nearly as many apartments as we should in the area. And then you have the overarching complex of the fact that there's no way to bifurcate between the drug and substance abuse issues and people that and mental health issues from the population that's suffering from economic crisis as well, right? And so it's sort of, we've built this machine in LA that is, we are really kind of providing a support network for people that come from all different facets falling into homelessness and the affordability crisis, right? And we're spending all sorts of resources on those issues that we're not doing so on an efficient basis. And I think that the first thing that needs to be happen in terms of a solution is I think we need to be bifurcating between mental health, substance abuse issues, and people that are, can be unfit for housing. And we need to figure out a solution for those people and how to get them the help that they need, but then not try and take up housing that's available for people that have economic issues and sort of conflating the two. Now, a lot of times those things you can have economic issues, end up on the street, and then end up in a substance abuse crisis and everything else, right? But right now, we're kind of in this housing first model that's been very challenging here in LA. And it is, and it's very hard to get housing built here.
Well, you hear these stories that it costs the government, I don't know, something like $750,000 a unit to build housing.
Yeah.
I mean, how does that compare to when you build?
So, I wish there was always more details on those headlines because it really does give the industry a bad name.
Yeah.
Right. So, I mean, our typical build, so we're building several deals in California right now, and our typical construction cost is probably somewhere around, $300,000 a door.
And what cities are these in?
And this is Bay Area cities.
Uh-huh. Okay.
We're building 2 deals in Antioch at the moment.
Mm-hmm.
I think that, the program in which you're building at 800,000 door is a specific affordable housing program that is not built for scale. It is built to build non-economical housing where people can't pay rent. So when it can't pay rent, you effectively get a grant to build the housing. When you get the grant, nobody's really watching the cost. But the largest, and those deals do get built for $1 million a unit, right? But at the same time, those deals, the largest deal you can possibly do is probably 40 units in California, right? So it's just not moving the needle. And it gets this headline risk that, oh my God, California's spending on and quite frankly, those deals they don't take a ton of local and state resources. A lot of that comes from federal resources that are coming in the program that's there. There should be better, incentives on the state side to put those deals maybe in areas where it's not 40 units and it's costing $800,000 a door, or they could probably build, at $300,000-$400,000 a door and do, 3 times as many units.
So, I mean, there are some people, skeptics, who say, well, it's completely a corrupt system. It's fraud. It's this and that. Well, I mean, what are you saying as to why it's just because it's so few units that from a scale situation, it will always be costlier per door as opposed to building several hundred units?
I think people have to understand the federal program that's there. The federal program it's a 9% program that is building all of those deals that are at those price per doors, right?
And when you say 9%, what specifically?
So 9% means that at, whatever your building costs, you get 9% of the total cost of that building back in the form of tax credits on an annual basis over 10 years. So if you add that up over 10 years, that's 90%, right? If you're in a location that's a high, difficult to develop area, which is a high cost area where this price per door is going to go up and you're building vertical, so it's already going to be much more expensive. You are incentivized on the federal program, you're going to get 130% boost on whatever that basis is, right? So you take 90% times 130%, that's going to get you your tax credit amount. You're going to sell that for 90 cents on the dollar. You run that math, right? You're going to get back more in tax credits than what you spent on the building, right? So there is no governor in there from a user standpoint in the kind of the way we think about public-private partnerships working. There's nothing on the private side that stops you from saying, I spend $5 million for this building, or per unit, right? Or $4 million.
Because you're going to get it back.
I'm going to go get Frank Gehry, right? And so and these deals are being built in locations in you're going to try and do deals in Santa Monica, in downtown LA.
Well, there were
the hardest to develop areas, most unique parcels, and most politically sensitive areas that don't want affordable housing. And so a lot of the nonprofit sectors, et cetera, have hired great architects. They've come in and they try and kind of build them the best that they can, right? And win over that local support. Then you add on the fact that the local municipalities, to get them approved, are like, you need to hire prevailing wage, you need to have all these other things that layer on top of it, right? And by the time you get done, it's $800,000 a door, right? If like I said, like that program, if that was not, if you didn't need to develop specifically in those downtown locations, and you had, I think our philosophy on affordable housing is that we have a product that we build. So we build a garden style product and we build a townhome product. Those are the two products that we focus on. And then we find sites that fit our product versus the typical affordable housing developer is getting a site and then they're cobbling together money, trying to figure it out. What's the program? How do they put it together, right? And so that's just a recipe for your costs shooting through the moon, right? And so I think that if we know our cost to build our product every single time we build. And this is, I think, part of why this is the differentiating factor on scale. And so if you're going to build at scale, and the best people to do this are the home builders, right? And the home builders know their cost to build a home, exactly what it is, and they have to find sites exactly where to put it, right? And so we're trying to adopt that same methodology for doing, affordable housing creation.
And so when you're building, how many units are you building at a time?
We typically are trying to look for sites that are 200 units plus.
Mm-hmm. And so, as I started at the outset of the podcast, how many of my clients are now getting into affordable housing? Where do you see the opportunities? Is it on the build side?
The question is, how many of your clients are getting into new tax credit affordable housing versus how many of your clients are buying existing deals and deploying into affordable housing?
I would say the vast majority are buying it existing. Right.
And so to me, one, I think that's a great thing for the industry, right? So for those of us that are dealing with the majority, a lot of what we do is developing tax credit housing, right? And developing new housing that's affordable, right? We also have a business line in which we are deploying capital, institutional capital, across the affordable housing space as well. But I would say that in general, the two sides of that need to coexist. And the more institutional capital that's coming into this space and more groups that are looking to buy existing deals makes a more robust exit market and more incentive for developers to get in and create new affordable housing, because you have an exit path. There's a path to success building these things. So I really think that's a great thing for the industry overall. And I think that the question is how many of those people will make that jump to saying I'm going to deal with the headache, or can deal with the headache of going in and building new affordable housing, which is really where I think we have our firm. We're a little over 30,000 units at this point, and we have about 170 people at the firm. If we were a market rate shop at that size, comparables that I know, maybe they're 30 people.
Interesting,
right? So it just shows you what you need from a scale standpoint to run and manage the complexity of these affordable housing programs at inception, and lease up, and kind of going through that whole process.
All right, we're almost at 50 minutes here.
Yeah.
Want to be respectful of your time. You and I are both born and bred Los Angelinos.
Yeah.
You couldn't get into Beverly High. That's why you went to Harvard Westlake.
Yeah, exactly.
I'm a Beverly High grad. Yeah.
I went to El Rodeo.
We're both El Rodeo alums. God, how unbelievable is that school now?
I haven't gone back and toured, but I've heard.
I
really
haven't
good
toured. I mean,
things.
just driving on Wilshire.
Yeah,
I mean,
I know.
my kids say, that's where you went to elementary
Yeah,
school.
yeah.
It looks like a college, Dad. So, yeah.
I remember riding my skateboard over the Robinson's May. Do you
Of
remember driving
course,
over that
of course.
Robinson's May?
Where
now there's a Amman.
Amman is.
So
Well, it's been a hole for 20 years.
the kids
but yeah.
can go next door and go to the spa. Eventually.
Oh man, I do remember riding my bike past the Robinson. My sister and my grandmother worked at the Robinson's May.
Yeah.
All right, so you are my first podcast recording since the election.
Yeah.
I mean, is there hope for us?
I think there's hope. I've tried to get very involved on the local side in the last year. I've been really motivated. It's just been a personal mission of mine. I've become convinced. My wife and I are both very active philanthropically, as I know you are too, here locally. I've really become convinced that it's not a great investment of my dollars philanthropically, locally, unless we can change the political climate, right? So, we give to causes that serve, underserved youth in South LA. We give to a lot of, kind of arts education type stuff in LA as well. And, and homeless causes as well. And it's like, if the numbers are not getting better on the public side from a homeless standpoint, safety, security standpoint, all the other things that make LA great as a city, then, we're just spending more dollars philanthropically. And it's, again, back to this thing that we have considered ourselves experts on now in public-private partnerships. Philanthropically, we can only spend so much, right? If we don't change the dialogue of what the local government's doing, our philanthropic dollars are just not going to go very far, right? And so I've become convinced that we really need to change that conversation locally, and that my dollars of what I spend philanthropically, a portion of that should go towards political spending, not just philanthropic spending, which I think is a new way of thinking for me. And a lot of other people I talk to are just there. I'm shocked at the lack of knowledge and involvement of people on the local level, right? And it's like, I play this game like, okay, like, who's your councilman?
Well, I know specifically. I mean, because
yes,
of Tracy Park.
Of course, right?
Or,
but like,
yeah. Now I'm in Santa Monica, but yeah.
Yeah, you're in Santa Monica, right? But like, I think that, like, I mean, you probably have a ton of friends who live just dispersed all around the city, right? And you can play this game of like, okay, like, who's your councilman, right? Have you ever stepped foot? Do you know what a neighborhood council is, right? Like, I mean, then you go to like other levels of like, who's on your neighborhood council, right? People are like, I don't even know there was a neighborhood council, right?
Are you involved in Thrive LA?
I am not involved in Thrive LA. No.
Okay.
So I am not involved in Thrive LA, but I've gotten very, very involved in Vibrant LA. So Vibrant stood out to me. Two different things. Thrive does really great work as well, and it's sort of part of the ecosystem.
Because I know that's what helped San Francisco get back to where they were.
So I got attracted to Vibrant specifically. Vibrant, I got involved because Jay Chung, who's an advisor or really not an advisor, but also helped set up Vibrant LA, was also the founder of the group that was really responsible for a lot of the great work that was done in San Francisco.
Okay, great.
And so really spent a lot of time studying what happened up in San Francisco and the changes that have happened there with Mayor Lurie and everything else. But that, they've been working on that for 5+ years up there, right? So, we're just getting started in LA, and I've just been getting started in the last, kind of year in terms of my involvement. But really what they figured out, in LA and in San Francisco in particular, and there's been setbacks in San Francisco too. I don't know if you're following what's going on in the transfer tax up in San Francisco, but they were going to roll back the transfer taxes. That now has stalled. They're now waiting on the statewide measure. There was a measure to actually make the transfer taxes permanent in San Francisco that got momentum. So they're still like fighting up there in a big way. But they have taken every county board of supervisor seat, every city council seat, every the mayor's office, as well as every person on the board of education. is like no longer, they have no, kind of
So it was a
card-carrying socialist
complete
members
turnover.
on there. Complete turnover to either, to the moderate side, right? Took them 5 years. They spent about, they raised about $8 million every 2 years. So over that 5-year period, and you're talking about 30, 40 million bucks, right? LA is 4 or 5 times the size of San Francisco, right? So it's a daunting task of what we have to do here in LA, but it switched. A lot of people think it switched really fast. Like I thought I noticed it took a year. There was a lot of work that was going on for years leading up to that. But I think a lot of people don't realize here in LA that we've switched. It used to be the primaries were in April. The final was in June, right? It was only, call it like, I want to say like a couple cycles ago, they switched the election dates to match up with the national election cycle. So now you have your primary, which is in June, you have your final, which is in November, right? We've become much more influenced and the electorate locally has become much more tied to the national election cycle and the news cycle going on and kind of what's happening with Trump and, kind of the Trump sentiment has become a huge factor in local elections. And the turnout used to be with those, cycles that weren't tied to that, April and June dates are now, our turnout has gone from what was it's at one point it was a low point of like 14%, 15%, 22% maybe, right? To now in the November elections, it'll probably be closer to like a 40% turnout, right? And the question is like, who's turning out, right?
Well, with the ease of voting, mail-in voting, ballot harvesting, like I don't want to be a conspiracy theorist, but it just the whole system is rife for manipulation, and it's just troubling to see the type of results be so skewed after the initial ballots are counted, and it just calls into question the integrity of our electoral system, which I've never ever would have thought we would be having this conversation.
Yeah, but it's like, to me, like, look, you can, there's two ways to go on this. I feel like you can focus and you can say, okay, let's just say there's a huge coalition and there's walkers going around and they're collecting ballots from, people that are homeless and homeless people and they're going to the local prison systems, because on the socialist agenda is abolishing the prison system. So they go down to the prisons and they say, hey, if you, and I don't know if you know this, but if you are not convicted of a federal crime, but only convicted of a state and local crime or a city of LA crime, you can still vote, right? So you can go down to the prison. There's a bunch of people in the holding cells in the prison systems, and you can go in and say, hey, do you guys want to vote in the election? Like, who do you think they're going to vote for if there's someone with a position that they want to abolish the prison system, right? So the question to me is like, is that person, I mean, based on the rules, like they have a right to vote, right? Homeless person sleeping on the street, like they have a right to vote, right? So we can get angry and we can say like, wow, someone has been smart enough to go and mobilize and get those people to vote and give them their rights. Cause I mean, they are US citizens and they're sleeping on the streets, but they're US citizens, right? And the question is like, where are they registered? Like, do we want to have better rules around somebody who like moved here from Nevada and lives on the street? But if they like moved into an apartment here, they'd register to vote. They'd be legal to vote.
Of course.
Right. So maybe they're, maybe we're going to draw a line that like, if they sleep on the sidewalk, they can't register to vote versus like, it's a very tough area for me in terms of where you draw those lines, and you don't turn off a lot of the people in the electorate in terms of taking away people's rights. But at the same time, I go to how many people are not involved, right? How many people have opinions that I talk to that are like, they don't know who their council people are. They don't know what's happening at city council. And it's like, if in San Francisco, what made the difference was they figured out that there was an Asian electorate that was not activated and that was dealing with all sorts of crime issues that were coming out, in which there was a few kind of Chinese grandmothers that, activated the community that had been assaulted and one was assaulted on a bus and, kind of had gone under different things. And they used that to motivate the community, and they activated those voters. And that was a 15% voter block. And when that voter block got activated, it didn't matter that the progressive side was registering whoever they were registering, getting them to vote and doing whatever. And even this last election, they still won, right? Because that bloc has stayed together and votes, right? And we have failed in LA to create that bloc and figure out what that kind of swing capacity is of people that realize that the city of LA, that we are killing the economic drivers in the city, right? So, yes, you can vote for higher minimum wage at hotels and everything else, right? But if you kill the hotel industry, like tourism is what funds a huge percentage of the city budget, right? So if we kill the tourist industry, like we're going to kill a lot of things across LA, right? And so it's like, I feel like we need to be able to get that core block. We need to all work together. I have huge, shout out to the work that Vibrant's doing across on the city council level, and kind of being the glue of bringing kind of that block together that can help move some of these elections to just the common sense sphere.
Yeah.
I mean, it's like,
no, it's now, we're now at the point where common sense is demonized as being inhumane. But we could,
look at Tracy. I mean, I can't believe that like her opponent still got, it was close to 40%.
I know. Well, thankfully she won, and we'll see. There may be higher office in her future in a couple of years from now.
Yeah.
Look, we've been going for an hour. We could go for multiple hours. We're not going to solve this situation sitting in this room, but I do know that you are, one of the pillars of the community, helping, affordable housing locally, statewide, nationally. And as I said at the outset, when I mentioned Jeff Jaeger, Standard Communities, everyone says, yeah, that's the number one company in affordable housing. So congratulations to all your success.
Thank you, Andrew. It's been a pleasure to be here, and it's fun to talk about this stuff. And look forward to getting a chance to talk again.
Absolutely. Thanks for coming on. And that's another episode of the Kirsh Connection.